Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Baidu's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Baidu is similar to Google, but it is focused on the Chinese market, where Google is in almost every country. Baidu is the fourth largest website in the world and second largest search engine behind Google. In September 2021, Baidu's monthly active users reached 607 million, up 12% year over year. It generates 61% of its revenue from selling ad space on its website, similar to Google AdWords. 24% of its revenue is from iQIYI, which is like Netflix but only available in China. It features original content and a library of professional content as well as user-generated programs. It has TV shows, movies, kids programs, documentaries, animation, sport programs, etc. There are 100 million paid subscribers and another 100 million using the free service. Netflix has 200 million members and Disney Plus has 100 million. The main difference with iQIYI is that it offers a free service with a large amount of content, but if you pay, you receive premium content as well. And as you know, Netflix and Disney Plus do not offer any free services. 15% of Baidu's revenue is from AI, or artificial intelligence. This has the potential to be its leading revenue generator in the near future. The company mentions its strategy is to invest heavily in technology and scale its AI cloud business. It currently has 8% of the cloud market, but it is so much easier to grow different business segments when you have such a large amount of people already using your search engine. For example, if a new cloud company came out, it would be an uphill battle trying to get people to use their service because no one knows who they are. In Baidu's case, pretty much everyone in China knows who they are. So it's a million times easier to attract customers to its cloud service or any other service it offers. To further improve its AI revenue, the company is investing heavily in autonomous driving and the robotaxi industry. The company holds more patents in this category than any other company in China. The CEO said in 3 years, our AI business may exceed our advertising business. The company's headquartered in Beijing, China, and was founded in 2000. The ticker trades on the Nasdaq, Mexican Bolsa, Deutsche Börse, Vienna, Swiss, Lima, Bulgaria, Hong Kong, Buenos Aires, and London Stock Exchange. Let's get started with the model. This is a large cap company, 59 billion market cap. They're trading at 170 a share, and they have 348 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They have pretty consistent free cash flow each year, around 2 billion to 3 billion a year. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that was over 6.5 billion in the trailing 12 months. Revenue is a sales for the company, and that grows steadily each year from 16 billion to 19 billion. This is the company's income statement. They report their financials in Chinese ones. I converted these numbers to US dollars on my Excel spreadsheet. The top line is the revenue, the sales. A quick way to convert to US dollars is just to divide the number by 7. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. The cost to maintain its website is part of cost of revenue. Revenue minus cost of revenue gives you your gross profit, and that peaked in the trailing 12 months at 60 billion. Below that is their operating expenses. Marketing is a big operating expense for this company, and below that is their operating income, which also peaked in the trailing 12 months at over 17 billion. They paid over 3 billion of interest on their debt, but they received over 5 billion of interest on their investments. So their net interest is positive 2 billion. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. An example is the gain on the sale of an asset. Then below that is their pre-tax income, then their taxes, and the bottom line of the income statement is their net income. Their trailing 12-month net income is double 2020, so it looks like they have a pretty strong income statement. This is the company's income statement directly from their quarterly report. This shows us the third quarter of 2021 in US dollars. They received $3.3 billion of revenue from selling ad space, $1.7 billion from other. This is from iQIYI, the video streaming service, and also their AI division. So $5 billion of revenue. Cost of revenue is $2.5 billion. Their gross margins are 49%. That's gross profit over revenue, which is a little less than the market median and average. They spent $1.1 billion in SG&A, selling, general, and administrative, and $957 million in R&D. So they had a pretty small operating income of $358 million. That's 2.3 billion ones, which is a lot lower than the second quarter of 2021 and the third quarter of 2020. If you include the items and other income and expenses, they had a net loss of 2.7 billion. But this is just the third quarter of 2021. For the 12 months ending 9/30/2021, they have positive net income. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So they generate lots of cash flow, but it is going down. It was close to $5 billion US dollars in 2018. Now it's under $3 billion US dollars. Remember, these numbers are in Chinese ones. They do spend a lot on CapEx. Operating cash flow minus CapEx gives you your free cash flow. And their free cash flow was high in the trailing 12 months because it looks like they didn't spend much in CapEx. About $4 billion. Operating cash flow minus free cash flow gives you your CapEx. For some reason, it's blank in Yahoo Finance. They spent a lot in CapEx in 2018 and 2019. It looks like they're funding a lot of that CapEx with debt. They added $42 billion of debt in 2018, paid down $21 billion. They increased their debt load over $20 billion, which is about $3 billion US dollars, and they increased it a lot in 2020 as well. It looks like they're issuing a similar amount of capital stock as they're paying down. Their revenue has been increasing at a nice rate since 2015. But their operating cash flows are pretty flat, so it seems like their expenses are getting up there. The projection through 2025 is for their revenue to continue growing, and their operating cash flow to grow, but not by too much. Let's look at the capital structure. $34 billion of equity, $15 billion of debt. They're 69% equity, 31% debt. But they could pay off all the debt with the cash on their balance sheet and still have $14 billion of cash left over. This blue line is their equity since 2015. The red line is their debt. The green line is their cash balance. Even though their debt is growing, they always have enough cash to pay off all their debt. So in a sense, they're debt free. And I gave them the lowest WACC, 7.91%. That's the WACC on Simply Wall Street. And that's the discount rate we're going to apply to the future cash flows. We estimated 3 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 3. That's $65 billion. We discounted those numbers back to today's new weighted average cost of capital. We get a value of the company of $59 billion. We divide that by 348 million shares. And we get a calculated stock price of 171. They're trading at 170. So they're trading at intrinsic value. This is definitely an anomaly. My model is usually not this close to the actual stock price. Their revenue is projected to grow 10.4%, so I grew their revenue 10.4% for the next few years. That's how I got their future revenue estimates. To calculate their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers and I divided by the sum of these 4 revenue numbers. And that comes out to 13%, so I multiplied their future revenue estimates by 13%. That's how I got their future free cash flows. Simply Wall Street values the company at $339. They're saying it's 51% undervalued. 9 analysts priced this stock and the average price target is $259, the lowest $175, the highest $330. This is where the stock has been trading the last 2 years. The stock was doing really well for a while, over $350 a share. The Chinese government was trying to block any Chinese companies from publicly listing in the United States, and a bunch of other tactics the government was using to limit the growth of Chinese companies. Which doesn't seem to make sense, but that's what they were doing, and that's why a lot of Chinese stocks have come down in price. But it is really interesting that my model says the stock is trading at intrinsic value, because my model indicates other Chinese companies like Alibaba are really undervalued. They have a beta of 0.94, so the stock moves with the market. It's gone down 44% in the past 52 weeks, while the S&P is up 14%. The 52-week low is 132, the high is 354. and the stock is trading below its 50-day and 200-day moving average. 2.5 to 3.5 million shares are traded each day on this stock. Of the 348 million shares outstanding, 269 million are on float. When a share is on float, that means it's available for people like me and you to purchase. 54% of the shares are held by institutions and 2% are shorted. Their employee count has been going down a little. They currently employ 41,000 people. If you invested $10,000 into this company 10 years ago, you'd be at $13,000 today. That's only 2.5% annual return. But it's definitely a roller coaster ride. You would have been up, then down, then up for a while, then down, then back up. 46% of the shares are held by institutions, 32% by the general public, and 22% by insiders. The CEO of the company owns 22% of the shares, then BlackRock, Vanguard, PrimeCap, and Dodge & Cox. Let's look at their financial ratios. They have an amazing PE ratio below 9. That's stock price over earnings per share, much better than the market median and average. Price to sales of 3.1, that's stock price over sales per share, or its market cap over revenue. Price to book is 1.7, which is also really good. Stock price over book value per share, or market cap over equity. Let's look at their non-current assets. 3.2 billion of fixed assets. An example of a fixed asset is a building. 1.1 billion of copyrights. 1.5 billion of produced content. This is for Aichi. 3.5 billion of goodwill. Goodwill is the premium you pay when you acquire another company. 11.5 billion of long-term investments. This could be common stock they bought in another company. 1.6 billion of operating leases and 2.5 billion of other. They have a good return on invested capital of 11%. They can cover the interest payments with their operating income more than 5 times. A really high ROE of 20%, that's net income over equity. The market median is 7.2%, the average is 2.3%. And they have a really high current ratio and quick ratio of 3. Let's look at their current assets. 6 billion of cash, 1.7 billion of restricted cash. Restricted cash is cash that's set aside for a specific purpose, like to buy a factory or to acquire another company. 22 billion of short-term investments. These are usually liquid investments like in government bonds. 1.4 billion of accounts receivables. This is how much money other companies owe Baidu. And 1.7 billion of other. Let's look at their current liabilities. 600 million of loans. 6.2 billion of accounts payable. This is how much money Baidu owes other companies. 2 billion of customer deposits. So these are deposits customers made for a product or service that they will need to deliver in the future. 100 million of loans, 750 million of convertible notes. This is debt that can be converted to equity. 900 million of notes payable. This is money the company owes maybe to a bank, and 400 million of operating leases. The company generated 2.5 billion of free cash flow in the trailing 12 months, and they have over 22 billion of working capital. So the company is really well funded. The best way to look at ratios is to compare them to companies in the same industry. There are 71 companies in the same industry as Baidu, and Baidu spends less than average in CapEx. Their average in debt to equity ratio. They generate a little more free cash flow than the average company. Of course, all these averages are dragged up by Google and Facebook. They have the 4th highest market cap, and their price multiples are really good. They have an amazing price to earnings ratio relative to the average. They have a good price to free cash flow ratio and a really good price to sales ratio. They bring in a lot more revenue than Snap and Twilio, and Snap has a higher market cap. They do have a really low 3-year annual growth rate, only 7%. Pretty much every other company on this list is double digits. So they're not really growing that much, which may be a reason people aren't buying the stock and pushing the price higher. And they have a good ROA and ROE. So to summarize, I have them trading at intrinsic value. And I know lots of people are concerned about buying Chinese stocks, and I definitely don't blame them. This is definitely one of the safer Chinese stocks to buy. I feel Alibaba is the best buy of all the Chinese stocks. I did buy it a month ago, but this is probably in the top 5. Being the 2nd largest search engine in the world is a pretty big asset. The companies that have the most people visiting their website tend to be the most valuable. So I think it's fine for a long-term hold, although it may be a bumpy ride for the next few years. I ranked their free cash flow 7 out of 10, their revenue 8 out of 10, and their ratio is 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.